April 2025 macro webinar, Liberation Day. I wanted to kick off this month's webinar by just taking a step back and just talking about the dynamics that we've seen over the course of the last couple of years. Coming into 23 and into 24, we basically had a dynamic where markets were expecting pretty weak economic outcomes. And it was at a time when essentially the underlying strength of the economy remained in place, despite the fact that there was a tightening of financial conditions and a tightening of interest rates. And as a result, the US economy outperformed relative to expectations, and so too did stocks versus bonds, which is essentially the market implied growth indication. And so we wrote an outlook in early 2024, essentially the first day of 2024, and our view was stronger for longer. And that played out very clearly through the course of 2024. But as we were coming into this year, for those of you who joined our webinar, say in January, we had a very different outlook. And the reason why that was because expectations for growth ahead had actually increased to the point where, in many ways, there was a euphoric expectation, a boom expected ahead, just at a time when we were starting to see elements of economic conditions moderating, and where we were starting to see some elements of fiscal efforts, really government, federal government policy that would likely be growth negative. And that divergence that we saw highlighted, was basically highlighted in our outlook that kicked off the year called Curb Your Enthusiasm, which wasn't necessarily, looking at the policy mix and saying that there was going to be a radically growth negative policy mix, but simply the expectations were very high. And it would be very challenging to fulfill those elevated expectations, and the distribution of outcomes were tilted towards the negative, particularly when it came to the performance of stocks versus bonds, meaning stocks underperforming bonds. And that's basically what we saw through the first couple of months of the year. What's really changed over the last few weeks has been the ratcheting up of the tariff efforts. And in many ways, the result of that is a greater set of negative fiscal policies that in some ways are even outstripping the market shifts that we've seen so far. And so what you see on this chart kind of gives you an indication of what's going on. A lot of that first move that we saw in the year, where stocks were underperforming bonds, was really about repricing or pricing out the euphoric expectations post-election. And really, we've only seen a modest decline since that point, which was really starting to price in the effect of the more extreme tariff announcements and other essentially global conflict that has started to emerge as a result. And so at this point, while these declines seem very, very large, certainly up close, and to be clear, over the course of single days, these are very large declines. Really haven't seen these sort of declines except in the middle of 2020 COVID, as well as in the middle of the financial crisis. The actual level of markets today still really is far away from pricing in the relatively extreme negative growth policies that, at least so far, look to be being pursued. And so I start with this chart of stocks versus bonds on a risk-matched basis. And I think it's important because stocks versus bonds on a risk-matched basis, you would expect to have a zero expected value over time, meaning the expected outperformance of stocks and bonds, if they are at a same risk level, should be zero. And so what you see here is we've really had 5 continuous years up until the last couple of weeks of growth being priced in massively into the U.S. stock market and the U.S. bond market. And that extreme has certainly moved down, but we're far away from pricing in the sort of declines that would typically occur with a meaningful economic weakening. When we scan across markets in general, what we see is that there's while again, the moves have been substantial, we're still quite a ways away from the type of market pricing that would align with pricing in a even relatively high probability of a meaningful recession. Stocks, while they've come down, the levels remain elevated. Bond yields remain elevated as well, both for nominal and real yields, and both on the short end and the longer end, right, are considerably higher than you typically see. And you're seeing a bit of curve steepening, but not nearly the type of curve steepening that would align with a typical recession. While spreads have increased in any reasonable context, high yield spreads in particular, are very low in any reasonable context, much more akin to sort of normal growth conditions than anything like a recession. And really, the only place that we're seeing meaningful weakening in terms of growth assets is really over in the commodity space, where we have seen, pretty weak crude prices and a sharp weakening of copper prices. Just to put those into perspective, crude prices today are basically, at where they have averaged over the course of the last 10 years. And we look at stocks, and it ain't close to how they've averaged over the last 10 years, way above where they've averaged over the last 10 years. And so you got to get a feel that other than the commodity markets, pretty much every market has seen a hit, but these markets have yet to fully price in the risk of a recession, or even moderately price in the risk of a meaningful recession. And in particular, the equity market, we see this in the internals, where while PEs have come down to about 18, give or take, depending on the day, that's still quite a bit higher than PEs of roughly 15 that mark bottoms in recessions, 15 or lower, I should say. And that pricing is reflective of forward earnings that remain at peak levels. They have not come down. So 240 earnings in 2024 are expected to turn into 270 earnings ahead. Whereas what you typically see in a recession is earnings growth or earnings falling somewhere between 15 to 20%, depending on exactly which recession you're looking at. And so when you look at that picture, what you see here is while the PE has come down, it's in the context of extremely elevated expected earnings growth. So a simple example is if we were to simply have flat earnings growth over the course of the next 12 months on 2024 levels, rather than an increase from 240 to 270, that would imply that the current PE is a little over 21 times. 21 times is basically the most expensive PE that we've seen, other than the tech boom and the immediate moment after the COVID recovery when earnings were depressed. And so valuations, when it comes to stocks, really look nothing like what you typically see in a recessionary environment, or even close to a recessionary environment. This is all coming in the context of a set of federal government policies that are extremely growth negative, uh, pretty much no matter how you slice it. And so I think there's a lot of conversation about whether what's happening here is often quoted as 4D chess, or whether, as I see it, it's much more close to a wrecking ball set of policies. And that's an important shift, because when we were talking about early in the year, our big focus was curb your enthusiasm. So, people were too enthusiastic relative to the set of policies that were likely to be implemented and relative to the range of likely outcomes. What's shifted over the course of the last couple of weeks is that the conviction around the accumulation of very negative growth policies has increased, and in many ways has increased much faster than the market moves have occurred. And it's referred to as a wrecking ball. I like to refer to it as a wrecking ball. The reason why I call it a wrecking ball is because not only is it a combination of negative growth policies, but it's happening in the context of government policymakers who look comfortable in their willingness to implement those policies, despite the fact that you're getting pretty severe negative market reaction. And While there's all sorts of reasons why that is, whether it be a long-term perspective or whether it be a politicization of asset holders in the U.S. economy, either way, it doesn't really matter if you're trading markets. What we have is negative growth policies where the reaction function to pull back on those policies uh, looks much slower than what you typically see amongst policymakers. And that's also true for the Fed, which is adding to the wrecking ball dynamic because the Fed uh, is essentially meaningfully concerned about the inflationary pressures of this raft of policies, particularly the tariff policies, which is handcuffing their ability to likely respond. And so even as stocks were falling almost 20% from peak, the Federal Reserve was more focused on having a conversation about inflation expectations not becoming not rising, much more than they were talking about the prospective negative growth implications. I think that's very telling in terms of what's going on. So you put that together, that really is a wrecking ball. And I'll start with this set of policies, and then we can talk through essentially their implications. But on the left-hand side of this chart, what you could of the slide, what you could see is this is the series of negative growth policies. So the tariff on foreign imports, probably something like a 1.5% of GDP hit if they were implemented as announced. May even be a little bit higher with the prospective China tariffs that are likely to that the additional 50% U.S. retaliatory tariff to Chinese retaliatory tariffs, getting closer to 2% as a function of that. You have foreign tariffs on U.S. imports, which those retaliations have been relatively modest so far, but may become more significant. You've got labor force slowing as a function of reduced immigration. And you've got a meaningful set of cuts, both from Doge, particularly in the employment area, as well as the prospective cuts coming from the proposed budgets that are necessary to get the political will to extend the TCJA. And that's important because on the other side, there's just not a lot in terms of the federal government policy mix here that is growth supportive. For instance, there's a lot of talk about a big tax cut, but TCJA extension is not a tax cut. Very important to recognize. It is not a tax cut. And the reason why it's not a tax cut is its current law. So by extending it, all we're doing is we're avoiding what would have been a very sharp tax hike rather than create a tax cut. So that is not actually growth supportive or growth stimulative. There is some talk, at least in the Senate bill, about implementing at least some amount of no tax for tips, Social Security, and overtime. But the size of that and its support to economic conditions pales in comparison to many of these other negative growth effects. You add this all up and compare it to what you see in terms of nominal growth in the economy coming into this, which had been pretty stable at around 5% for the last couple of quarters, and looks like it'll be, it might be in that ballpark, maybe a little bit softer than that, at least in the first couple months of the first quarter. There's not a lot of give to this economy before you start to see a meaningful contraction, particularly in real terms. And this is really the challenge that the U.S. economy faces at this point. Of these various policies, of course, the biggest is the most influential is the tariff policy. The Liberation Day announcement that was made in total, combined with the other sectoral tariffs and other odds and ends that have happened so far, including at least the first couple of China tariffs. Through Liberation Day, it represented a 20% hike in the U.S. effective tariff rate in essentially, in the matter of a few weeks. That's a rate which is higher than what happened in the Smoot-Hawley tariff period of the Great Depression, and probably even more importantly, has happened in a way that is so acute that we've never seen such a sharp rise. It's multiples of the rise that happened with the Smoot-Hawley tariff implementation. And this is, of course, before the 50% additional retaliatory tariffs on China that were used in retaliation of the Chinese retaliatory tariffs. So we're seeing an escalation. Those would probably add a few more points to this and make the picture even more extreme. It's important to recognize that the flow through of these tariffs are likely to be substantial to the everyday consumer. Now, in many ways, we're in uncharted waters. No country in history has instantaneously, no country as large as the United States, I should say, has instantaneously created a 20 or 25% hike in their tariff rate. And so, what the exact macroeconomic effects of that are unclear. They're certainly untested through time. But what we can do is we can look at previous instances where we see maybe more targeted tariff policies flowing through to the real economy. A good example, a very well studied one, is the washing machine tariffs of 2018, which showed that essentially the tariffs flowed through at more than 100%. And the reason why that is because those tariffs created a price rise in adjacent products, particularly dryers, because they often are priced similarly or when you buy them as a set. And so effectively what we saw was actually the tariff rate, the effective tariff flow through is something that the effective tariff flow through was higher than the actual tariff rate. And it's interesting, we're actually seeing signs of this in the US economy today, particularly around the auto tariffs, where initial indications are not only are we starting to see essentially the foreign producers of cars start to flow through the pricing. It's probably going to take a little bit because it takes a little while for menu prices to work that way. So we're seeing those flow through. But what we're also seeing is we're seeing prices of used cars for those producers rising rapidly at auction. And in particular, we're also seeing the price of used cars of domestic producers rising at auction as well. And so it's important to recognize that while tariffs affect imports specifically, they may have an impact that even flows through to domestically produced goods as a result of competitive pricing. We also should expect these tariffs over time to increase employment in the US. And I think that's certainly the case is being made by the new administration that these tariffs will create a reindustrialization of the US economy. And in small scale, that idea can be stress tested by looking at these particular instances. So again, turning to the washing machines, what you see is that essentially there was something like a $1.5 billion increase in costs to consumers, which, is obviously much more significant than the tariff revenue that was raised. And there was an increase in jobs, onshore jobs that were created as a function of that, about 1,800 new jobs. But effectively, they cost $1 million a piece. And to be clear, those job holders did not earn $1 million. They earned, much closer to the median wage. And so the incremental tax income was de minimis as a function of that. But consumers essentially created a transfer payment just to get those jobs in that were many multiples of the income earned. And so effectively what you see is what you should see with what you would expect to see with any tariff announcement, which is consumer loss. That's what you're seeing is consumer loss, a flow through of the price rises to onshore prices that will affect consumer prices. Those effects may be beyond what you would see in the directly tariffed goods. And while you see an increase in domestic production, it's almost always at such a much higher cost, such that the consumer is paying significantly for a much higher priced product, and therefore, essentially eating the cost for de minimis gains when it comes to employment. We also saw essentially the same thing, the same flow through related to the China tariffs. In 2018, I've talked about that to some extent in previous webinars, which you can go back to. where what we saw was the flow through on import prices of about 85%. And so the idea that, a foreign country pays for it or a foreign producer pays for it, while we haven't tested that in the extreme the way we have here, we've been implementing it, or it's going to be implemented. Indications are that essentially you can see that as a direct fiscal pass-through and tight. Now, the real question about in terms of how this all flows through is how do all of these tariffs, how do they influence end demand? And what you see here, to get a rough sense of how this will flow through, currently we've got about 3.3 trillion of imports prior to the tariff announcements and prior to this most recent spike, front running the tariff announcements. Typically, we've got a total impulse of about 20%. Typically, you'd have about a 1.5x demand destruction, maybe 1.5x as the prices rise. And so we'd expect to see something like a 30% cut to total tariffs, resulting in about 2.3 trillion of imports once the tariff effect fully flows through. With the 20% tariff increase, you'd expect to see about a $450 billion increase in projected revenue. That's about 1.7% of GDP. And it's about 5-ish% of total outlays, 5 or 6% of total outlays, which is of the government, I should say, which is, of course, meaningful in terms of influencing the deficit, but not nearly enough to offset the existing deficit, which is running about $2 trillion. And so that tariff rise is certainly helps the deficit, but it is not nearly enough to actually deal with it. And I think the interesting thing is this is close to an optimal tariff rate in terms of compressing imports and raising revenue. One of the challenges is as you get to a tariff rate that's higher, you get so much demand destruction that essentially it becomes marginally negative. You don't get much more marginal input on it. And so, we're sort of right in the ballpark of what you'd expect in terms of an optimal tariff rate when it comes to a revenue raising standpoint. And so it's not surprising that this is roughly where it, essentially netted out. If left on its own with no increase in with no retaliatory tariffs abroad, this would probably be enough to close the US trade deficit, given the demand destruction we're likely to see. But as Lee Corso would say, not so fast, because retaliatory tariffs are certainly likely to be in place. And we're already starting to see some effect of those retaliatory tariffs happening, particularly in China. And so while we're likely to get a meaningful decline in imports, the real question is how much of a decline in exports are we likely to see that will meaningfully offset it and also create an economic drag on the US economy. You see, these tariffs were meaningfully were discussed as simply US retaliatory tariffs. And that is malarkey. Global trading partners, from an economic standpoint, have instituted very modestly higher tariffs than what the U.S. has implemented on foreign trade partners. The chart on the left-hand side gives you an indication of what that mix looks like. And when you net this all out, coming into this year, the U.S. had tariff rates about 1.5%, including the 2018 and 19 China tariffs. And foreign trade partners had a tariff rate that was about 4.8%, so about 3.3% higher. So the economic tariffs on U.S. exports were frankly de minimis, and pretty much high rates were concentrated in smaller countries that didn't matter so much. We had meaningful free trade agreements with Canada and Mexico, and while we don't have a free trade agreement explicitly with Europe, the tariff rates on U.S. goods in Europe were only marginally higher than they are in the U.S. The U.S. effort to implement these tariff rates is pretty extreme and nothing like what you'd expect with just tit for tat economic tariffs in place. Of course, the argument is that there are non-tariff barriers, and that by looking at trade balances, you're going to have an effect on those. They better capture the non-tariff barriers. But there's all sorts of reasons why you might expect economies to not have demand for U.S. goods, particularly developing economies who may not be nearly as wealthy as the U.S. and demand high value U.S. goods. Or also important to recognize, in many of these cases, the US is providing a variety of different services and effectively getting goods in response. And so the US deficit in aggregate is not nearly as substantial as simply looking at the goods trade. Given that, it's not surprising that we're seeing a variety of explorations of retaliatory tariffs, since the U.S. imposed goods tariff is extraordinary in comparison to the tariffs that were being charged to U.S. exporters. China, of course, was the first mover. Kind of amazing on a Friday night of a holiday, bringing out their retaliatory tariffs. And probably when you add it all up, the 34% tariff on U.S. goods from China will lead to a drag of about 20 basis points of GDP. The reality is not a big deal in the scheme of things, in part because we don't export a lot of goods to China. Uh, and so their retaliatory tariffs are modest in terms of their effect on the US. The big question is, what's Europe going to do? The US exports, something like $370 billion of goods to Europe, and European producers, and as a function of that, if Europe implements sizable tariffs, just think about it. If they were to implement a 10% tariff with that 1.5 multiplier, you could easily have an effect on the US that's meaningful in terms of its drag on GDP. And so, it remains to be seen what's likely to happen. Of course, there's a lot of conversations about whether there will be trade, grand negotiations and deals struck, et cetera. Is that going to happen or not? Hard to know, is the reality. A lot of the rhetoric certainly aligns with a continued push on these elements. We will have to wait and see. But in many ways, as a macro investor, it's probably you're best positioned to simply take the current administration at its word, understand the macroeconomic consequences of it, and then be ready to change your positioning when and if those tariff announcements occur. I mean, just take, for instance, the Liberation Day announcements, which were far more extreme than many had expected in the market. Of course, the only way to get the moment of the announcement move is to have had a bet on the fact that the announcement was higher or more substantial than was expected. But like 80% of the move, 90% of the move happened after the moment of the announcement in terms of the financial market pain. And so while, of course, it would be great to try and predict exactly what moves are likely to happen, you're much better off understanding what the macroeconomic consequences are once you know what the policies are, than trying to get ahead of them. The real risk, and maybe one that's already starting to emerge, is what happens if there's a capital war. Foreign central bank holders hold something like $3 or $4 trillion of U.S. treasuries. A number of those are on the shorter end of the curve, but still a significant amount of sales of U.S. treasuries and other financial assets would have a meaningful effect on the U.S. interest rate structure and on the U.S. economy. And notably, what we saw just after the election was a meaningful amount of selling by these foreign central banks. And that happened to coincide with a relatively substantial rise in term premium and yields in the US economy. Here we had, on the upper left-hand chart, you see about $100 billion of sales over the course of a couple of weeks. And that created something like a 60 basis point rise in term premium. There's some other things going on, but I think you get the basic picture that these economies, these foreign central banks wouldn't have to do much to have a meaningful effect on the US interest rate structure. And it's possible we're seeing that in recent days. And important to recognize that it would not have to go through, they would not have to take this capital and invest it in other currencies because they could simply hold it in cash deposits, whether it be in offshore banks or on US onshore banks. And so they can have all the duration effect that they want without having to take a currency risk. And in many ways, a smart approach may be one that's more targeted on the asset prices than the currency in order to confuse investors and the administration about what exactly is going on. But it's not just foreign central banks that are the big risk. The reality is that the foreign private sector, particularly large institutional investors in Europe, have been critical to the funding of US duration over the course of the last couple of years. Uh, on the lower right hand chart, I show what the total duration supply was in the year ending September 24, which was about $1 trillion of total duration supply. And of that, foreign central banks, while they're big holders of the stock of US debt, they were not big buyers during that period. Who were the big buyers were basically European real money. And if that European real money were to evaporate, the US would have a very hard time continuing to finance its deficits. The US is continuing to spend in a way that aligns with a $2 trillion deficit. If those foreign investors don't come in, it will be very challenging for US rates to be at the same level. And so there's a lot of fragility here in terms of the US financing situation. I think one of the things that's confusing, I think, to folks who are sort of new to international cross-border trade and capital flows is a lot of folks will look at the efforts that the US is making and talk about how it will constrain or it will reduce our financing need or improve our trade deficit. And that is probably true, as I showed in terms of the elasticities and the sensitivities. But the issue is capital moves a whole heck of a lot faster than trade, and capital is what determines asset prices, both bond and stock prices. And the US has been, in many ways, very lucky over the course of the last 5 or 10 years, because what's happened is about 70% of 70 cents of every dollar of capital that has gone into global financial uh, that has gone into global financial prices has gone into U.S. assets in specific. And that's been an important reason why U.S. assets have continued to outperform the rest of the world. But what that also means is that that flow of capital has to continue in order to support asset prices at these levels. And one of the consequences of raising tariffs is that you're also reducing the amount of capital flows out of the US paying for those goods, which means that foreigners have less capital available to invest in US assets. And as a result, almost mechanistically is negative for US asset prices. In addition to that, we see a big divergence in terms of the growth stimulation across various economies, where you have places like Europe and China taking efforts to stimulate their economy and have larger fiscal positions, larger fiscal deficits at the time when the US economy is, the US federal government is engaging in a series of negative growth efforts. So you put that together, that's not a great environment for the continuation of US financial assets receiving 70 cents on the dollar of every unit of capital flows that are coming in. And so that's an important consideration, essentially the flip side of the trade efforts that are being made by this administration. In addition to the tariff policy and the risk of a capital war, the Doge effort is, making real efforts to meaningfully cut back on federal government labor. Over the course of the last, couple of decades, federal government share of labor of the overall labor force has been basically flat at about 1.5%. And today it totals about 2.5 million workers. There's been significant indications and circulating documents that that the new administration is making an effort to cut about a third of jobs across various agencies. That third of cuts would lead to 800,000 layoffs over the course of 6 or 12 months. And in pretty much any context, that is a significant amount of labor force supply that would come into the market. But it's even more important in the context of a zero immigration environment. With immigration at zero, basically what we have is we have a baseline amount of job creation, meaning the amount of job creation that's necessary to keep the unemployment rate stable, in a conceptual way. And when you look at that right now, what the upper right hand chart shows is that without any humanitarian immigration, our baseline labor force growth is running, basically at under 100,000 a month for private payrolls. That's really important because if you take a look at the government that's going to cut 800,000 jobs, that's 8 months or more of non-farm payrolls, of baseline non-farm payrolls. That is a huge effect on the economy. Now, so far, that hasn't started. We've only seen small signs of it in terms of the volume. But if that actually comes to fruition over the course of the next 6 to 12 months, it would be a massive negative on the labor market and the economy. And finally, from a federal government standpoint, we have to recognize that the budget and the appropriations that are coming together are likely to create at least some cuts in the market. Now, there's a question of exactly how many cuts. Basically, everyone takes the TCJA tax cuts to be extended as a given on both chambers of Congress, and most market participants expect it to happen. The real question is what sort of cuts, what will be the net of additional cuts that are required to get that legislation passed relative to any additional tax cuts like no tax for tips, Social Security, or overtime. The House budget that was passed a few weeks ago contemplates simply the TCJA extension, no additional tax cuts, and a $2 trillion increase in spending cuts. That's over a 10-year period, so another $200 billion, give or take, on an each year basis. The Senate big beautiful bill, which was passed a few days ago, contemplates a TCJA extension and effectively zero in net spending cuts to offset it, with some amount of with an expectation that the tariff revenue will increase, will somewhat offset some reduction in taxes for tips, overtime, and Social Security. In either case, in the US context, probably the biggest limiting factor is right now is getting, from a political standpoint, is getting policy through the House, which is narrowly controlled by the Republican Party. And so therefore, odds are more likely than not that we'll see the House bill be the primary bill that is likely to, the primary terms, let's say, that is going to be passed. And this $2 trillion in spending cuts, were it to happen, you'd still get a widening deficit. You'd still get continued issuance of bonds for that widening deficit. It's just that you would get these tax cuts or these spending cuts, particularly targeted at high propensity spenders, lower income, high propensity spenders, that would create an additional growth drag on the economy. So where's the Fed? Because typically stocks fall 20%. The Fed is out there with rhetoric saying that they're going to support the market and ensure liquidity. And the reality is the Fed has been conspicuously absent over the course of the last couple of weeks. In fact, Chairman Powell, in the midst of one of the worst S&P 500 days that we've seen over the course of a couple decades, was making a staid speech about inflation expectations. I think it highlights that the Fed is very concerned about the inflation credibility and the risks that tariffs bring to that inflation credibility and the progress that they've made. And frankly, doesn't really care much about weakening equity markets, given the risk of higher inflation. And, it makes some sense. If you look at the upper right-hand chart, the big problem here is that the Fed is starting to see some inflation data that is, again, has been above their target for an extended period of time, and if anything, is perking up. And at the same time, the unemployment rate, which is what they're primarily focused on, it's at the 20th percentile right now, is pretty darn good, all things considered. And so, of course, that may change as economic conditions deteriorate, but the Fed is not these days in the business of predicting what's going to happen to the unemployment rate. They're in the business of looking at the unemployment rate and seeing how it flows through. And so, one of the things that may even constrain an unemployment rate rise is the fact that we have a zero net immigration environment. Will create a situation where uh, you know the limited labor supply will help offset any job losses when it comes to the unemployment rate, which means that the unemployment rate may rise more slowly than the slowing of economic conditions, relative to the last couple of years. And so you put that together, the Fed is not really in a position to move rapidly in response or really get ahead of any growth weakening. And notably, the market is not pricing that in that way. The market is pricing in a very aggressive Fed response, particularly over the course of the last couple of days. And yet the macroeconomic fundamentals do not align with an aggressive Fed response. So look, you've heard me yammer on for a while. And the reality is the current policy stance can be summed up in this cute little meme, which is Trump wants stocks down, Bessent wants stocks down, and Chairman Powell wants stocks down. And if that's the case, the path forward is pretty clear, which is sell the rip rather than buy the dip. And that's a very different environment than what we've seen over the last couple of years, where investors have been really rewarded every time by buying the dip. Whereas what we've seen in the last couple of weeks is investors have been very rewarded by selling the rip. And while professional investors have been the primary ones making those trades so far, and retail investors have predominantly come in and bought the dip, if that dip buying were to fade, particularly from the retail clients, as recently as what we've seen in Thursday and Friday of last week and Monday, if that buy the dip mentality starts to evaporate, there really is not a lot of demand that exists in the market underneath those bids. And given that, that creates the real risk that we have a more meaningful air pocket down given the current level of valuations before we get to a point where value-oriented investors and financial professionals come in and look for opportunities. It's not a great picture, let's be honest, but it's the reality, at least as we see it. And until policy changes significantly, the path forward is relatively clear. We are on a path for a federal government policy-driven recession, and one in which one that is likely to occur in an environment where asset prices coming in were very elevated. And that creates the real risk of a self-reinforcing dynamic where the federal government negative growth policies create a slowing of growth, which then creates a weakening of asset prices, which flows through to slower growth. That's the real risk. And unless these policies are meaningfully reversed in the short term, that's the path that we're on. And at current price levels, both in stocks and in bonds, we're not really seeing a material risk of recession sufficiently priced in.